The state of the financial services industry is at an inflection point, and here to talk with me about it is Tony Davidow, author of a new book called Goals-Based Investing. Tony, welcome.
Thanks for having me, Bob.
It's a pleasure to have you. And as folks may know, we're walking our way through various blogs that you've written that speak to the chapters in the book, one of which has to do with the state of the financial services industry. And there are a lot of trends to cover. Any come to mind that sort of think people need to know about?
Yeah, I think there's a couple, and I think you're right to kind of characterize it as the industry's at a key inflection point, and sometimes that feels intimidating, but I think we'll ultimately see some opportunities falling out of that. But I think the trends that I kind of start to frame in the beginning of the book are, we're certainly seeing a lot of fee compression, and the fee compression manifests itself in the rise of passive investing, the rise of model portfolios. We're seeing investors being much more discerning and really challenging what is the advisor value proposition? What am I paying a financial advisor for? And we're seeing a lot of focus on financial advisors really kind of going back to the drawing board, reinventing their practice, and thinking about what are all the capabilities that they need to bring to clients beyond just managing a portfolio, but thinking through what are the trust and estate issues, what's the retirement planning sort of construct that I need to think through. So I think we're evolving as an industry, and I think it will ultimately be a healthy process as we come out the back end of this. I think individual investors should ultimately be the beneficiary of all the changes going on.
Yeah. So one of the trends that I've noticed is not only is there fee compression going on, but there's also margin pressure as folks, clients ask for more services and perhaps fees declining, that we may see margins decline for advisors, or is that not a trend that you see?
I think absolutely. I would say that declining margins for financial advisors and also asset managers. And if you just think of the whole wealth management ecosystem, if everyone's margins are now shrinking and yet clients are expecting and wanting more, what's the answer? Well, I think part of the answer is technology, right? Part of the answer is, can advisors effectively embrace technology to help scale the practice, not to minimize and take away their value proposition, but could that be an enabler that provides more efficiency and scale in the practice? And I think that is something we'll have to see how it plays out over the next couple of years here.
Right. And then in terms of fee compression, part of the trend, I think, toward that has been the rise of passive investing. Any thoughts about that trend and where it goes from here?
Yeah, and again, I'd argue that's a very good thing for individual investors. I think if we kind of take a step back and we think about where this all started, index-based strategies have been around for decades. ETFs go back to 1993, but a lot of big institutions have been indexing for decades and decades. But what we really saw after 2008 was an acceleration as a lot of asset managers had a difficult time protecting client portfolios in the downdraft of the market. And we started to see the first generation of cheap beta strategies, ways of very efficiently owning market segments at cents on the dollar. And that wave, I think, really just introduced individual investors to ETFs as ways of getting exposure to the market, but also expanded the toolbox of financial advisors who started to realize that these tools could be very efficient ways of getting exposure. And rather than paying fees for mutual funds or SMAs that might be more expensive, they could get a cheaper entry point. So the evolution of indexing really started off with cheap beta as the first entree into the space, which was immediately followed by smart beta, something you and I have talked about quite a bit over the years. And smart beta are essentially strategies that have leveraged some of the academic research that shows there are certain factors that have been persistent over time. And could you use a rules-based methodology to capture those factors in an elegant solution like an exchange traded fund? So I think that's been a very good thing for the individual investor, both if they're doing it on their own or if they're working through a financial advisor, because they now have cheaper and more efficient access to many segments of the market that were very difficult to access just a decade or so before.
Right. And I'm sure folks would be curious to learn your thoughts about smart beta and what trend continues or not there.
Yeah, so as you know, I've written quite a bit about it. And again, that first generation of cheap beta strategies were really designed to just replicate the major benchmarks that are out there, major indexes. So the S&P 500, the MSCI, the Russell indexes are all market cap weighting, meaning the largest companies have the largest weight in the underlying index. Made a lot of sense. It was cheap. It was efficient. It was easy to do. But why do we assume that the best companies are always the biggest companies? And in fact, academic research will show you that isn't always the case. And in fact, oftentimes there's a premium for identifying smaller companies or more value-oriented companies or companies that generate yield. So what smart beta came along to do, smart beta, strategic beta, factor investing, that nomenclature is kind of used interchangeably. What they came along to do was say, well, what if we change the weighting and screening methodology to very specifically target things that we wanted to have in our client portfolios? So if you're an individual investor and you wanted to have more income in your portfolio, could you have a income-oriented portfolio and weight that underlying index in a way that generated higher income? Or if you wanted to be more of a value tilting strategy, could you in fact employ a different screening methodology rather than just arbitrarily providing the highest weight to the largest companies? What the data shows is most of those strategies outperform the market cap equivalent by a pretty big margin over the long run. And in fact, I've done research looking at not only here, where most of the research started, but in fact, we see the exact same experience if we look at the international and emerging markets. So it gives the advisor an expanded toolbox. So I want to own a segment of the market. And now you make the determination, do I own it in a market cap fashion? Do I own it in some sort of smart beta methodology? And what sort of bets and biases do I want to introduce? Do I want it more value oriented, more growth oriented, more quality? Do I want low vol because I'm concerned with the volatility of the market? So it's a really smart toolbox that we provided to the advisor. And ultimately, it's the benefit of the individual investor who can very easily access these strategies.
So I think I want to talk about active ETFs, but maybe not today. We'll save that one for a future discussion. I want to turn my attention to this trend about practicing diversity in both in terms of attracting a more diverse workforce, but also attracting a more diverse customer base. What's going on with that trend?
Yeah, and Bob, you and I mentioned it in our last podcast that unfortunately most of the financial services industry looks like you and I, white male dominated. In fact, if you look at the U.S. Bureau of Labor Statistics data, I think 83% of the financial advisor community is white male oriented, 32% women, a much smaller percentage African Americans, Latino, and Asian Americans. Which that's not really matching up with who the ultimate demographics are of the clientele that many financial advisors serve. So I think many organizations, the organization you and I are involved with, the Investment and Wealth Institute, introduced the Thrive Initiative. I know firms like Morgan Stanley, RBC, and others have internal initiatives to encourage mentoring, which I think is a really positive development as we think about this. We just can't arbitrarily put people in those spots. We need to provide the training. We need to provide role models. We need to provide mentoring. And I would hope that in the next several years, we start to see a real big demographic shift. So we start to see a lot more diversity of women and minorities getting a larger share of the financial services community, which ultimately I think serves clients well because clients often want to identify with people who look like them. Yeah. The other sort of demographic sort of shift in there is the rise of millennials, which now represent the largest buying unit that's out there. So again, we need to get younger, we need to get more diverse, partly because it's good for the practice, but partly because it helps us identify and relate to a diverse group of clients.
Yeah. This is a case where I hope the saying, the more things change, the more they remain the same, won't be true going forward. I hope they change for the better, like you as well.
Me too, yeah.
So anything that we haven't touched upon about the future of the financial services sector and the inflection point that we're at?
Yeah, I'll maybe just kind of offer some information that you and I talked about in the last call, which is I think for many, change is threatening, whether you're a financial advisor or you're a client who chooses to do it on your own. Oftentimes change just feels very uncomfortable because it's a journey we haven't traveled before. But like you and I, who have been through so many changes over the years, what we find is change often provides opportunities. Change often provides new ways of doing business, better ways of doing business, better ways of engaging clients, better investment tools at our disposal than we've ever had before. So personally, I'm leaning into these changes because I think the future is very bright for our industry. It will likely look different than it does today. Hopefully we'll be more efficient. Hopefully we'll be more diverse. But I'm very comfortable that those who lean in and choose to invest in themselves will flourish in the next generation. And those who continue to play with last year's playbook will likely be left behind.